What actually happened in Southeast Asia in 1997? Step into the late 1990s and witness the 1997 Asian financial crisis that shook East and Southeast Asia. It all started in Thailand in July 1997, and soon, like ripples in water, it spread to other countries, making everyone fear a big global economic disaster. Starting in Thailand, where it was called the Tom Yum Kun crisis on July 2nd, the problem began when the Thai baht collapsed because the government had to let it float instead of keeping it tied to the US dollar. This happened because Thailand didn't have enough foreign currency to support its peg to the dollar. This led to people quickly moving their money out of the country, causing a problem that spread internationally. At that time, Thailand had a lot of foreign debt. As the issue spread, other Southeast Asian countries, and later Japan and South Korea, experienced a drop in their currencies, lower stock and asset prices, and a big increase in private debt. The amount of money owed by these countries compared to their income went up significantly during the crisis. In South Korea, for example, the debt went from 13% to 21% and then as high as 40%. Thailand and South Korea were the most affected, with their debt compared to exports also going up. Other newly industrialized countries in the north managed the situation better. South Korea, Indonesia, and Thailand were the countries most affected by the crisis. Hong Kong, Laos, Malaysia, and the Philippines also faced problems. Brunei, mainland China, Japan, Singapore, Taiwan, and Vietnam were less affected but still experienced a loss of demand and confidence in the region. While Japan was slow to help the affected countries, China earned a better reputation by contributing $4 billion in bailout money and deciding not to devalue its currency. Despite seemingly sound fiscal policies in most Asian governments, the International Monetary Fund, IMF, stepped in with a $40 billion program to stabilize the currencies of South Korea, Thailand, and Indonesia, which were hit hard by the crisis. However, these global efforts didn't do much to stabilize Indonesia's domestic situation. President Suharto, who had been in power for 30 years, was forced to step down in May 1998 due to widespread riots caused by sharp price increases from the drastic devaluation of the rupiah. The effects of the crisis lingered through 1998, affecting global markets, and in 1998, the Philippines experienced almost zero growth. Singapore, although relatively insulated, still faced challenges due to its role as a major financial hub and its proximity to Malaysia and Indonesia. By 1999, there were signs of recovery in the economies of Asia. After the crisis, East and Southeast Asian countries worked together to achieve financial stability and improve financial supervision. In the late 1990s, East and Southeast Asia grappled with a financial crisis rooted in economic bubbles and distorted policies. Thailand, Malaysia, and Indonesia saw their economies inflate due to speculative investments and crony capitalism. Despite earlier success as attractive investment destinations with high growth rates, external shocks, including currency devaluations and rising U.S. interest rates, altered the economic landscape. China's emergence and excessive real estate speculation added complexity. The crisis exposed distorted incentives in lender-borrower relationships, resulting in an unsustainable economic climate and collapsing asset prices, triggering widespread debt defaults. It stands as a cautionary tale about the delicate balance needed to maintain financial stability and prevent the pitfalls of distorted economic policies. Amidst the 1997 Asian financial crisis, panic gripped lenders, triggering a massive credit withdrawal that led to a credit crunch and numerous bankruptcies. Foreign investors rushing to pull out their money flooded the exchange markets, causing the crisis countries' currencies to depreciate. To stem the collapse, governments raised domestic interest rates significantly and intervened in the exchange market, buying up excess domestic currency. However, these measures were unsustainable due to limited foreign exchange reserves. The subsequent flotation of currencies led to further economic chaos as foreign-denominated liabilities surged, causing more bankruptcies. Accusations of deliberate currency manipulation by ASEAN countries and accusations against currency traders, including George Soros, added political dimensions to the crisis, highlighting the challenges of international cooperation in times of financial turmoil. IMF role. The widespread and severe economic collapses during the Asian financial crisis prompted an urgent need for external intervention. Given that the affected countries were among the wealthiest globally and with hundreds of billions of dollars at stake, a cooperative and international response became imperative. In response, the International Monetary Fund, IMF, implemented a series of rescue packages tailored for the most affected economies. These packages were designed to prevent defaults and were contingent upon the implementation of reforms in currency, banking, and financial systems. What were the impacts and consequences on Malaysia during the financial crisis? In July 1997, shortly after the devaluation of the Thai baht, speculators heavily traded the Malaysian ringgit, causing an abrupt increase in the overnight rate from under 8% to over 40%. This triggered rating downgrades, leading to a widespread sell-off in both the stock and currency markets. By the end of 1997, ratings plummeted from investment grade to junk. The KLSE market lost over 50% of its value, dropping from above 1,200 to under 600, and the ringgit's value declined by 50%, falling from above 2.50 to under 4.57 against the US dollar on January 23, 1998. Prime Minister Mahathir Mohamad responded by implementing stringent capital controls and pegging the ringgit at 3.80 against the US dollar. Malaysia's measures included fixing the local currency to the US dollar, prohibiting overseas trade in ringgit currency and other ringgit assets, restricting the amount of currency and investments residents could take abroad, and imposing a minimum one-year stay period for foreign portfolio funds, later converted to an exit tax. Declaring offshore ringgit holdings invalid also dried up sources that speculators borrowed from to manipulate the ringgit. The suspension of CLOB, Central Limit Order Book, counters froze approximately $4.47 billion worth of shares, affecting 172,000 investors, mainly from Singapore, sparking a political issue between the two countries. In 1998, the real economy contracted significantly, plunging Malaysia into its first recession in years. The construction sector shrank by 23.5%, manufacturing by 9%, and agriculture by 5.9%, resulting in an overall GDP decline of 6.2%. The ringgit dropped below 4.7, and the KLSE fell below 270 points. Defensive measures were announced in September 1998, including moving the ringgit from a free float to a fixed exchange rate regime. Bank Negara fixed the ringgit at 3.8 to the dollar, and capital controls were imposed, rejecting aid from the IMF. The economy then stabilized at a slower but more sustainable pace, transitioning from a massive current account deficit to a substantial surplus. While asset values did not return to pre-crisis highs, banks were better capitalized, non-performing loans were handled systematically, and weaker banks were acquired by stronger ones. Despite a $14.06 billion surplus in 2005 compared to the 1997 current account, foreign investor confidence remained low, partly due to transparency issues in handling CLOB counters. In 2005, the last crisis measures were removed, transitioning from a fixed exchange system to a managed float, resembling the Singapore dollar. This decision, while stabilizing the currency temporarily, had long-term implications for Malaysia's monetary policy. In 2005, Malaysia made a pivotal move by transitioning from the fixed exchange rate regime to a managed float system. This shift allowed the value of the Malaysian ringgit to be determined by market forces, marking a departure from the previous rigid peg. Since then, Malaysia's currency value against the US dollar and the Singapore dollar, SGD, has been influenced by various factors, including economic conditions, interest rates, inflation rates, political stability, and global market trends. The exchange rate is no longer solely dictated by historical pegging but responds dynamically to these multifaceted influences. Today, Malaysia stands as a testament to its resilience and adaptability in the face of adversity. The journey from pegging its currency to embracing a market-driven exchange rate system reflects Malaysia's commitment to fostering sustainable economic growth and prosperity for its people. But some say Malaysia has been staying stagnant since 1998.